Good morning, everybody. Welcome to the last quarter webinar of this year. It's been a long year as it is. So let's hope we can close this on a high, and we can close off where everybody is informed. So I think before I start, everybody would be seeing for the first time a joined a slide of NMG Sequoia Capital. Maybe just to get some context around that. So Sequoia Capital is a division of NMG Benefits. NMG Benefits is a large financial services provider covering various areas from pension fund administration, actuarial services, investment consulting, employee benefit consulting, short-term insurance, financial planning, and healthcare brokerage. And Sequoia Capital is the in-house investment management business within NMG Benefits. Hence, you will be seeing two brands for a specific reason, that Sequoia Capital operates not only in the retail space, which is the point of today's webinar, where we manage unit trust portfolios, model portfolios, and various other retail-oriented portfolios, but we also operate and manage institutional portfolios for for all of our default retirement fund clients. So hence, going forward, you would be seeing both of the brand names. I think let me just get to today's agenda. So we're going to first do a market update, which will be covered by Msizi Msomi. Msizi is a portfolio manager at Sequoia Capital. We joined to look after the execution of our group investment strategy and process through the various portfolios we manage on the retail side. And then we've asked Dr. Chris Harmse, our consulting economist at Sequoia Capital, essentially to join in and just to provide us an update on some of the economic variables that they look at within the Economist of the Year competition. So he is a participant of that competition, and I've asked him to highlight maybe 4 key variables and speak about 4 key variables that I think is quite relevant to everybody on this webinar this morning. So I've asked him to speak about the expectations and also the predictions for SA growth, our interest rates, the oil price, because oil price is one of the big drivers of the petrol price, and also what he expects in terms of our rand-dollar exchange rate. So I'm going to ask everybody, if you have got a question, please just put that in the questions and answer box at the bottom. We will gladly answer all the questions that you've got. But before I hand over to Msizi, I thought I'd just share one interesting slide that I came across this past week, it's quite interesting that we talk about polarization, and now, because I think post the Rugby World Cup, we all kind of feel patriotic, we all feel united, but we know that tends to fade away. And what I want to show you is 2 studies. The one on the left-hand side, and your left-hand side, is done by the Edelman Trust. It's their barometer. So it just shows you the polarization. And on the left axis, you can see it says, how divided is my country? So the higher up you go, the more divided it is. And on the bottom axis, it says, can we overcome these divisions? So if you're in the top right-hand corner, it means that you think the country is extremely divided and you don't think we can overcome it. So obviously there is South Africa, slam bang in the middle, in the top right corner, just underneath Argentina. But I think the interesting fact is that you see countries like the US, Spain, Sweden, that's grouped next to us. So SA is not unique in what we're experiencing as a country. There's a lot of first world countries that kind of have the same feeling that we've got. And I just want to kind of cement this study by showing the chart on the right-hand side. Now, this is a study that's been done by Goldman Sachs. So Goldman Sachs is one of our primary research providers. And this is a study that they've done on the same topic. And if you can just see, this is their heading for the study. It says the US is more politically polarized than many other countries. And it's the same access. I mean, the division there is and the entrenchment of that division there, and there's South Africa again. But again, there we've got the US, we've got Spain, we've got Sweden. Not long off there is Italy. So I don't think SA is unique in what we're experiencing. This is quite important when we look at this. We realize this because we tend to make our investment decisions. We base our investment decisions on emotion and what we're perceiving, what we're experiencing as a country. So keep that in mind, and don't let emotions take over when you're making investment decisions. So with that being said, I'm going to hand over to Msizi just to take us through the market update.
Thank you, JB. Good morning to you all once again. So today, my name is Msizi, and I'll be taking you through some of the events that have happened in the market and how they ultimately affect the way in which we manage our portfolios. So just to give a quick recap, some of the trends that are coming through, the narrative of interest rates higher for longer by most central banks, and the very muted to low growth environment in the global stage for Q3. We have seen that coming through in the various asset classes, and obviously oil prices. There's a lot of political tension that's also affecting the oil price, and also that oil price then makes the inflationary pressures worse in terms of your transport and food cost. And obviously last year was a Russia-Ukraine war story, and now more recently it's happening in the Middle East. And we're also seeing that China has had moderate growth, although that growth has been a bit above the consensus expectations. And just to touch on slightly on the medium-term budget policy statement, which happened on the 1st of November. I mean, obviously, it's important to note that the midterm budget policy statement is not an environment for policies to be made or decisions. It's just a gauge to check how far we are from the targets that were set in February in the original budget speech. So just to go through some of the market dynamics, we just pulled this table on the left top corner. That's the asset class returns. Now this slide is important. Now these asset class returns are important because essentially this is what the asset managers have in their toolkit to carve out a return profile. And as we can see, when you look at the South African local asset classes for the quarter ending September, I mean, all of them are either flat or very muted returns, and we're seeing this with earnings deteriorating. The earnings estimates deteriorating, faced by a lot of headwinds in the market, including the likes of your load shedding, interest rates, and long-term growth expectations as well are slightly less there. And when we look at the global stage now, this is the global asset class, the global indices, equity indices, and in their specific country base currency. And we can see that, I mean, for the first quarter, second quarter, it's been a positive story. And for the third quarter, this is what we're seeing. Most of these asset classes, or rather these country-specific indices, have been struggling. And we can see this in terms of what's been going on, the higher for longer political tension that's coming through. But on a local, now bringing it a bit closer to home, looking at it locally, we can see that when you look at the various sectors within the equity markets, we can see financials and industrials have done better this year, as we can see in the first quarter and the second quarter, while resources have really been struggling. And since the post-COVID-19 economic rebound, the South African mining companies have enjoyed levels of performance and shareholder returns. However, in the past year, this regression has been experienced in these metrics due to several changes that are coming through in the industry, and we're seeing that the miners have been quite disappointing, and we know that 50%, about close to 50% of our exports come from these mining sectors, and we know what an impact it has on the economy. And just to touch on the war, I mean, I touched on it a bit earlier, but essentially there's three scenarios that we kind of see playing out here. I mean, the war's confined, it's a proxy war, it's a direct war. I mean, conflicts in the Middle East tend to lead to spikes in the international oil price, given that the region is nearly contributes a third of their global oil supply. So obviously that's the transition mechanism that's involved in this particular war. Now, when you look at it when the war is confined, I mean, there's very little impact on the oil, an additional $4 to the barrel, no implications on the volatility index. We see GDP slightly dipping and inflation slightly increasing. But when you go further up, or further down rather, you start to see that the impact of the spillover effects tend to be felt a bit more on the oil prices and the growth numbers and inflation. I guess the extent of the financial market impact will depend on also the level of involvement of other major regional superpowers, you know. But obviously you'll see higher energy prices, which will also lead to that narrative of higher for longer. And just to show another picture of the risk that's in the market. So the dark blue line, that's your volatility index. Now some would say it's the fear index from a market perspective. When you look at and then the light blue, that's your geopolitical risk index, and you can see that, you know, when there's a lot of geopolitical risks and fears, I mean, markets are hardly affected by it. I mean, when you look at the Gulf War, 9/11, the Iraq invasion, and the Ukraine war, the volatility index has rather remained flat. I mean, with the table next to it, this just further reinforces the notion that wars don't necessarily impact the market. Yes, there is a lot of noise that's happening in the media. We switch on the TV, you hear about all these things, but the impact that exists or that is derived from these wars is very minimal. The effect is very minimal. I think it's also understanding where the macroeconomic environment or condition is, or that persists at that particular point in time, to get a better sense of the impact that it has. And when you look at some of the impacts, you know, of the higher for longer inflation narrative, this is one of our primary providers, research providers, Goldman Sachs. I mean, they've got this very interesting chart here, which just goes to show that this is the blue line, the base case. You know, interest rates are going to be higher for longer, only expecting a rate cut later 2024. But with longer cuts and higher for longer, we see that there might be a possible hike again in the first quarter of 2024. But then if there's a subsequent growth scare, or maybe there's a recessionary fear, or the recession starts picking up more rapidly, we start to see that, you know, there are higher probabilities of the Feds cutting interest rates at these points. We can see with the light blue line and the gray blue line. And I mean, also interesting to note that when you look at this table here on the top right corner, this is out of 85 banks, central banks in the world, and these charts on these columns rather are the number of banks that actually increased their interest rates over the years. And you can see in 2020, very few banks were increasing their interest rates, and post-COVID rebound that general markets expected, a lot of these central banks started to hike their rates in response to the inflationary pressures within their various economies. And we can see throughout about 2022 to about 2023, a lot of the central banks were hiking the interest rate, and more recently, we are seeing less and less central banks increasing their interest rates, and this further reinforces the higher for longer narrative. And the graph at the bottom, this is an out of possible 85 banks, central banks in the world. A bulk of them here were decreasing their interest rates, and we're decreasing their interest rates. And as you go on the years, you start to see that not a lot of banks were decreasing interest rates, but more recently, some few banks have been cutting their central rates. And I mean, just to look at what's happening in the markets globally, I mean, this graph here just basically shows how markets are valued, you know. So this gray line, this gray bar line, this is the minimum and this is the maximum, and then this is the highest point. The green bar, that's your average, it's your long-term average, and the blue diamond, that's where the market is currently valued. And as we can see, from the world, relative to the world rather, is at fair value, and we can see that with the USA, it's above the historic average. And you can see now that what that implies is that US markets are a tad bit more expensive than historical averages, and if it's below the green line, I mean, these valuations are a bit cheaper. That just goes to show that when we construct our portfolios, we look at these numbers from a long-term perspective, because obviously you can't make, you know, short-term calls on PE ratios. You tend to have a longer term view when it comes to these numbers. And when you look at the EM emerging market region, you can see that fairly valued. China is still regarded a bit. India is regarded a bit expensive, and the rest of the markets and the rest of the economies, South Africa is relatively cheap, which just goes to talk to opportunity sets that are in there. But basically, most of the EM regions are relatively cheaply valued. And just touch on China a bit. China grew above consensus expectations, and this was been largely driven by consumers, because obviously after the zero COVID policy and once they started reopening the market, there was a lot of pent-up demand from the consumers' perspective. So you can see that this dark blue line represents the growth component that is measured by consumption. And as you can see that over the years, this year from Q1 to Q3, it's been largely driven by consumption. But what is concerning is that, you know, the exports are still are not providing as much support or contributing that much to GDP, to the growth numbers. But obviously this is something that we look at, we monitor, and hoping to see that a lot of stimulus is provided by the government. Okay, and then just to quickly touch on the South African markets. Yes, this is what I touched on earlier, that South African markets are cheap. Looking at the 12-month forward PE, we can see that markets are still relatively cheap. And relative to other emerging markets, we can see that South Africa is still cheap. This dotted line the solid line is the average, the higher end, the lower end. And you can see that South Africa, relative to other emerging markets, are really cheap. And this just speaks to the opportunity sets that lie within the local markets. And I've just included a slide here that just shows the index beta for China and the other economies, or rather markets and regions. And as we can see here, this is how this essentially measures how a particular region moves relative to the Chinese economy. And as we can, and then the line at the bottom here just shows the level of revenue exposure that they have to China. And as we can see, South Africa, somewhat joint at the hip with China. We can see that, I mean, South Africa derives close to about 10% of revenue from China, and there's a higher correlation with the Chinese sector. And this just also goes to reinforce that, when China wasn't growing as much, there wasn't a lot of demand for resources, minerals from a Chinese perspective, and we did see that coming through. Now, let's just take taking all of that in, we just take a second to kind of dissect how returns are derived. Now, when you look at this pie chart, this is essentially the whole of this chart is a return profile. Now, how is that dissected? The default asset mix, when you look at how your particular strategy, staying invested in a particular strategy that you have based on your outcomes, the default strategy and just merely staying invested, 57% of your returns come from just merely staying invested. And then 27% comes to security selection, but in our case, this is asset manager selection. And then 16% of the return is derived from those shifts in asset allocation. I'll just explain it a bit more, just make it a bit more relatable. When you look at these two bar graphs, this is your conservative portfolio and this is your balanced portfolio. Now, for an example, if you just stick to a balanced portfolio, if you just stick to an investment, you would have in effect gathered 57% of a return just sticking to that particular investment portfolio. And then your security selection is looking for asset managers within these various components, like your SA equity, your SA bonds, and so forth and so forth. And then when it comes to the asset allocation, that's just making small tilts based on market conditions. For an example, going underweight local equities instead of 46% being 42%. Now, those are the small calls that are made in between, and that's how a particular return profile may be derived. So, what type of investor are you? When you look at this, this is actually quite an interesting chart, but just looking at it, the blue shaded graph, that's the flows into US mutual funds. Now, this shaded, this line here, this bar line, just merely shows, this line shows the growth of the S&P 500, which is the US indices. So now, when markets were going down, a lot of people were pulling out of their funds. Now, this then feeds into managing fear and greed. Now, obviously, when markets are going down, people are fearful and just pulling out of their investments. Markets are going up, a lot of inflows. People are plowing into these mutual funds and so forth. Now, this is counterintuitive to investing 101, where you sell high and buy low. In this case, the behavior that is exhibited is mostly of people buying low and selling. Buying high at this point and selling low. So that means basically there's a lot of what's this destructive behavior that is coming through here. And that's all I had to say today. And thank you for joining in. We'll see you during the Q&A section.
Thanks, Msizi. Really appreciate your insight. I think that if you one takeaway that I can take from the slide is that there's a lot happening in financial markets, a lot of things that we're uncertain about, a lot of factors that can influence financial markets, which you don't even normally know how that's gonna play out. But in the end, if you look at the decomposition of where your return comes from, essentially you can secure a third of your returns by just staying invested. But that's given on the premises that you are already invested in a diversified, well-developed and well-structured portfolio. And I think the one thing, again, which I said in the beginning, is that emotions can take over, and it can play a part in making how you position your portfolio. And I think your last slide is just clear evidence to that statement, where you can see that investors have clearly been pulling out assets at the wrong time. I mean, investments 101 is buy low and sell high. And the data clearly just indicates that we're doing it completely wrong. We are essentially selling, we're selling at the bottom, and we're buying at the top. So and that's not the way we do it. So thanks for that, Msizi. I think we're going to hand over to Professor Chris Harmse just to take us through some economic variables and what we can expect from our economy. Thanks, Prof. Chris.
Thank you, JB. Thank you for all the support I have to be able to look at this economic variables. Now, what we've decided to do is to look at what the other 34 top economists in South Africa thinks about some economic variables. Now, this competition, Economist of the Year, I think it's about 40 years running. Up to 2021, it was run by Media 24. Basically, it started with the old Report newspaper, and then it went over to Media 24. But due to financial situation, they were not able to sponsor the Economist of the Year from 2021. And then the Bureau of Research from UNISA, they took over this competition, and it's now more a competition where our economists comes together twice a year to speak about what we think is happening in South Africa, and then also to make a choice of those economic variables that will have the biggest effect, of course, on your GDP growth figure. Now, these are some of the economic variables which will have an effect on the dependable variable, your GDP growth rate. Now, the thing about this one is exactly the same. How do you keep emotion out of the market? How do you keep emotion out of your economic predictions? And what do you use as a model to do some predictions going forward in a time when we have three of the most difficult shocks, external shocks in the world global economy? Of course, the COVID-19 pandemic, followed by the Ukraine-Russian war, and now the problem of Israel and Hamas. The situation that, of course, puts external shocks on the economy, and every time our economists must be very careful before we baptize it as a black swan. An unpreventable situation that we cannot, of course, forecast on the one hand and did not expect. That's a so-called black swan. Now, the economists of the last 2 years felt that these are the most important variables which will affect the economy. Now, let us just say it's not affecting the market. So this is not financial economist, right? You are academic economists. There are economists for big institutions. There are private economists, and not all of them are doing this prediction by looking at what financial markets is going to do. We simply come up with a prediction by looking at those variables that would likely have an effect on our average annual GDP growth rate. Now, these are the variables, 7 variables that the economists themselves voted on 2 years ago. Now, of course, average consumer inflation rate, that's for a whole year, so we have to predict that. Now, the difficult ones is the average primary interest rates in Q4 as well as the rand dollar exchange rate. It's almost impossible. I had a PhD student that tried to forecast the rand, and she couldn't do it. I think she stopped at 72 variables. So it's almost impossible to predict the rand dollar exchange rate in a quarter. You may do it on average over a 10-year period, but to get it in a quarter is very difficult. So normally what we do is we make use of a analysis of panel data where it goes about expectations of what's going to happen with the rand dollar. And then, of course, the Brent crude oil price, the same thing, because those two, in a quarter four, you have to manage sentiment of what's going to happen. Then, of course, average real annual household expenditure growth rate, that's a more easy one. It's for a whole year. So one can use a regression analysis going over the last 35 years and come up with an average annual household expenditure growth rate. And in most cases, all the economists got this one correct over time. There's a relationship between household expenditure and economic growth, of course. Economic growth is definitely not so like in the US, but definitely in South Africa is dependent on, of course, household expenditure growth. On the other hand, again, household expenditure growth rate again is a function of the prime interest rate. So these things are working in tandem with each other, but all of them have an effect on economic growth. Then, of course, the average yield on the long-term government bonds as a long-term capital market rate in quarter four. And then, of course, South Africa, that's an open economy. Economic growth is a big function always of the current account balance of the GDP. There were years in the 70s and 80s where it was well known that South Africa's economy had a growth ceiling due to the current account deficit caused by sanctions. So these are the economic variables that we have to predict. Now, what I did here, I said, right, let's first go and I just want to see if I can change this. Right. Yeah, let's just go in. What did the 35 economists first month in February 2023? Because every year we start in February and our last prediction is in December. Right, so in February you can see that the average annual growth rate was 0.8%, whereas SECOA at that stage had it on 0.3%. Interesting thing, by September, it changed around. The consensus of the 35 economists was down to 0.4, whereas our model have put it on 0.8. Interesting that, and you will see later what the IMF and the budget of last year also, of last week, the medium-term policy statement also have now South Africa's average real annual growth rate at 0.8%. You can see what the inflation rate is about. We were very stable throughout the whole year. SECOA had 5.2 in February. Consensus was 5.8, and now we are almost on a consensus of 5.8%. Look at the average prime rate. Beginning of the year, it was only on 10.5%. Most of the economists, we didn't thought that it will go up by another 1.25% on average. Right, and it was due to the fact that inflation rates stayed sticky higher. We had a high oil price, and then of course we had the effect of Ukraine war on European economies as well as in the US, and also the fact that the Fed had increased its bank rate far more than was expected. So that all had an effect that the Reserve Bank didn't have a choice also to increase interest rates. And I think another reason why the prime rate in quarter four is going to be about 1.5, 1.7% higher than in February was due to the fact to the rand dollar exchange rate. Because the rand dollar exchange rate at the beginning of the year, SACOA had it at 17.13%. The consensus was 16.8%. And now by September, Sequoia had it on 18.2%, and the consensus for September is on 18.5% at the end of September, right? The October data we will have this year. This week. The second thing that I did is say, okay, let's now look at what global economists like the IMF, etc., think about South Africa. So the global forecast for South Africa in February was that they only had South Africa's economic growth rate on 0.1% global houses. Whereas our consensus was 0.8. Can you see how it turned around? In other words, it seems though that your international houses and your global view from international economists looking at South Africa, they see South Africa a more positive economic growth rate of 0.9%. With their October predictions. We already have some of the October predictions here as well. Look at the inflation rate, more or less on the same level. Average prime rate is at the beginning of the year. The global houses put South Africa on 10.25. Our consensus was 10.5, and now we're all up to 11.8, suggesting that there may be another interest rate hike during this month, because we are at 11.75 at this stage, right? Very other interesting thing is about the rand dollar exchange rate. They were every time a bit more pessimistic than South Africa. The global economists looking at the South African economy, and they had the exchange rate on 17.80 during February, and now they have it on 18.80, whereas our consensus is down to 18.50. Now, looking at the rand today, at about 8.65, it seems that we can expect the rand to be somewhere between 18 rand itself and 18 rand and 50 for the rest of the year. So it's not running away with us. I think the big surprise would be the oil price. So if you look at the oil price, it is most of the predictions on the oil price was on $85 a barrel. Now that we are close to 8 and even under $80 a barrel, it may affect most of these variables going into the last 6 weeks of the year. It seems though that the oil price rather will go down to $75 per barrel, which will have a far more positive effect on the average rand dollar exchange rate, and of course on the average consumer inflation rate. If you take a thing like petrol and diesel, we just had now at the beginning of November a decrease in the petrol price of R1.72 and 82 cents, sorry, R1.72 at 82 cents per diesel. The predictions up to yesterday was that we can expect the petrol price in December to go down by about R1.80 and the diesel price by more than R2. So this may affect some of these indicators in the next 6 weeks. So we may finish this year or end this year on a rand dollar nearer to 17.50 rand than 18.50 rand. And we may end the year with the inflation rate rather going down to 4.3 to 4.5 to give you an average of about 5.6% for a year. So we may be surprised with to the upside in the next 2 months of the two main indicators, the average consumer inflation rate, as well as the average rand dollar exchange rate, which may be more favorable to the South African economy, and that may, in fact, have a more favorable effect, of course, especially on the capital market, on the bond market. So if those two variables come down, especially the average consumer inflation rate, as well as the average rand-dollar exchange rate in the next 6 weeks, one can expect that the capital market will improve even more and more. JB, I think that's that. Thank you.
Thank you, Prof. Aram. So just to reiterate, if you've got any questions, please can you just pop those questions for us into the questions and answers panel. I see there's one attendee that's got his hand raised. So if you can just maybe just send us a question in the questions and answer section, we'll gladly answer that. I think whilst everybody's typing their questions, let me just ask a couple of questions that I've also got. So Msizi, maybe if I can start with you. I think the one question that I do have is that what we've seen is that there is a big disconnect between economic realities and what's happening out in what's playing out in financial markets. What we're seeing in the economy, and it's not necessarily filtering through to our market. What would the possible reason for that be?
Thanks, JB. Yes, that is true. There is a disconnect. But now, when you look at the JSE and the makeup of the JSE, you know, a large portion of the revenue that is generated within the JSE listed companies are from companies with dual listing. So essentially, they derive revenue offshore. So the noise that you hear locally in terms of the politics and everything that you hear generally doesn't have that much of an impact with what's going on in the markets, because obviously, you know, the market is largely driven by exogenous factors, and we do see that coming through, you know, with your rand hedge stocks, you know, deriving their revenue offshore, and naturally we will then, you know, hear something here locally and then would start to panic and make decisions. But ultimately, these things are just short-term noises with very little impact in what's going on in the market and what we're hearing in the news. I hope that answers your question, JB.
Thank you, Msizi. Yes, no, much appreciated. Of course, this is a question for you. It's from one of our attendees. They're asking, are we going into a recession?
There's a big possibility next year. That will depend, of course, on 3 factors. Will the US economy also move towards a recession, especially if they're going to keep interest rates higher for longer? If the commodity prices come down quite extensively, especially our commodities that we export in terms of gold, coal, other minerals, as well as agricultural products. And then, of course, the whole story about what's going to happen with South Africa's interest rates. At this stage, we all predict that the economy is unlikely to go in a recession. When will it be a recession? When we will have 2 consecutive quarters of negative growth, quarter and quarter, annualized and seasonally adjusted. Now, we were close to it in the 3rd and the 2nd quarter. We don't expect that in the 4th quarter. And given the predictions that the South African economy is going to grow by 0.9% this year and over 1% next year, the possibility is getting more slim that we will move into a recession. One thing that we also have to keep in mind, just like what Mzizi said, even on the economic side, what's happening in the global economy have a far more bigger effect than what's happening locally. Things like commodity prices, the Chinese economy, the US economy, all have an effect on our exports, and they all have an effect on our economic growth. but we do not predict the economy to go into a recession. There was a large prediction that it would have happened in the first and the second quarter. In fact, it didn't happen, and we don't expect it in the next 5 to 6 quarters. So it will be low. We may have another negative economic growth rate in the first quarter. But again, the main thing at the end that will determine an economic recession will be, of course, load shedding. If load shedding gets less, like it is at this stage, there's a prediction that the South African economy can even do better. Now, if the Minister of Electricity can keep load shedding down over the next 6 months to a year, we may be surprised that the economy may grow even higher. So there are a few of these factors. But at this stage, it seems all is up to the good, and the risk is getting smaller and smaller that we go into a recession.
Thanks, Prof. Chris, for that clarity. I think he summed it up quite rightly, is that if you look at what the 3 factors that's going to influence South Africa going into recession, it's essentially what's happening in the US. Will the US move into a recession? The one also obviously being China, and the effect of that China will have on our commodity producers. And then lastly is the movement of South African interest rates. So, but if I can maybe start at the US, if you look at the expectations for the US, current market probability is that the US might go into a recession, and that probability sits about 65%, and it's trending lower. So it was even higher at some point in time. Goldman Sachs puts that probability at only 15%. So the question whether the US is going into recession is a really difficult one to answer. I think it's not about whether the US will go into a recession, but more about the way in which it goes into a recession. If everybody thinks back about the chart that Msizi showed about the potential pulse of US interest rates. So if we have a geopolitical event that just like the Middle East, that just spills over into a transition mechanism like oil, which again influences global growth, then you would expect interest rates to start coming down quicker, which will also have an impact on us. I think the one thing what I want to mention about the US growth rates, that don't be alarmed when you see a really shocking US growth rate for the last quarter of this year. It is expected, and we expect it. And the reason behind that is that we've got the resumption of the student loan payments. So remember, students with outstanding debt at a period in which they didn't have to pay those loans. That's will start to pick up again now in the fourth quarter. We had the auto workers union strike in the US. It's a massive industrial strike. We kind of think that labor strikes is only common to South Africa. This is a massive labor strike in the US in such a sense that it has the potential to detract from US growth. Then we will start seeing the effect of high interest rates in the US start filtering through now. So don't be alarmed when you do see that. I think in terms of South Africa, the prognosis for South Africa going forward is that, if you recall what Prof. Chris said, is that we probably see a stable oil price, and we're already saying that there's a possibility that the rand could strengthen a bit. That means that the flow through to CPI is not going to be severe. So we might have a stable to a downward trending CPI. That in effect could imply that we've reached the top of our interest rate cycle, and there's essentially a probability that interest rates start to decrease at some point in time next year. But again, that some point in time, the decrease is going to be fully dependent on what's also happening in global markets. We are an extremely open economy, and we do take our cue from whatever is happening in global markets in China and in the US. And the saying goes that if the US sneezes, we catch a cold, and that's definitely still the case. So I'm not sure if there's any more additional questions. If not, I would like to thank everybody for attending this webinar. This recording will be distributed, so you'll have a second chance to listen to it. And I want to urge you, if you've got any questions, please feel free reach out to us. We will gladly answer your questions, clarify anything. If you need assistance, we'll gladly assist you with whatever inquiry that you've got. So with that said, thank you so much, and have a wonderful weekend. I think it's weekend number 2 without the Springboks putting us on a knife's edge. Let's just hope the Proteas pull through. We've got one more game, and then we hit the semi-final. So let's just wish them all the good luck, and hopefully they can do the thing and also bring back the Cricket World Cup for us. So until we talk again next quarter next year, hope you all have a good festive season that's coming up. And yeah, so don't let your emotions get a hold of you when you're investing. Thank you so much.